If you want to leave some assets to your family when you die, the first thing you really need to understand is how everything is going to be taxed when you pass away. So today I'm going to talk about how a bunch of different assets are taxed as soon as somebody dies. Now the first thing you need to understand is that if you're married or have a common law spouse and you pass away, as long as your assets don't have a direct named beneficiary who isn't that person, everything can flow tax-free to your spouse, which is great. But when the second spouse dies, immediately upon death, it's like everything was sold. So today I'm going to talk about how that looks. I'm going to look at somebody who has a pretty substantial estate with a whole bunch of different types of assets. The only thing I'm really going to not include is a business or a trust, because there are a bunch of different planning things and it's a little bit more complex than I feel like getting into today. So let's look at a list of their assets, and I'm only going to mention the purchase price or the book value when it actually matters. So what do they own? They have a $500,000 house. They have $200,000 sitting in cash. They have $100,000 in their tax-free savings account, and they have a life insurance policy with a payout of $250,000. They also have an RSP worth $500,000, a non-registered investment portfolio worth $500,000 with a book value of $200,000. They have a cabin worth $500,000 that they purchased for $100,000 a while ago. And lastly, they have a rental property worth $200,000 that they bought for $100,000. So how is everything going to be taxed? Well, I'm going to lump everything into three different categories. First, there's some tax-free stuff. Next is the fully taxable things. And lastly is everything that's taxed as a capital gain, which is why I mentioned the book value. So first off, all of the tax-free stuff, you've got the house, the cash is going to be tax-free, the tax-free savings account is going to be tax-free, and any life insurance proceeds are tax-free. So they have $1,050,000 that's completely tax-free right there. Next, you have an RSP worth $500,000. That's considered to be sold, and all $500,000 of that is going to be income the day that they pass away. And lastly, you have capital gains. So you have the non-registered portfolio that had a capital gain of $300,000. You have the rental property that had a capital gain of $100,000, and you have the cottage which had a capital gain of $400,000. So right there, they have $800,000 worth of capital gains, but since capital gains are only taxed at 50%, $400,000 of that is taxable as income. So if you total up their taxable income in that year, it is $900,000. So if we're talking about an Albertan who died with these assets in 2017, a taxable income of $900,000 is going to have an average tax rate of 44.37%, which is works out to almost exactly $400,000 worth of tax that they owe. Now their estate is worth $2,350,000 after tax. Now one thing to consider, especially in provinces other than Alberta, because we only have probate of $400 no matter what the size of the estate is, provinces like Ontario and BC have really high probate rates. So somebody in Ontario would owe 1.5% on the value of that estate, so they'd owe north of $41,000. With a little bit of planning, they could actually reduce that by $12,750 with about 15 minutes worth of paperwork, which I will talk about in a couple weeks' time. But next week, what I want to talk about is the biggest fear that Canadian retirees have is your money going to last through retirement? So I'm going to talk about the steps we can take, the things we can control to make sure that your retirement lasts as long as possible and you can have the income you want. Thank you.